Hello and good morning, everyone. Welcome to week 3. This week, we're looking at financial management. And today I'm going to be taking the lead with Professor AG as usual. So obviously, you guys know we're going to dive into a bunch of different things, KPIs, all of that fun stuff. But first, I will start.
I believe, one second. That's Chanel. I think she got dropped. Give her 1 second. She should be coming back shortly. Sorry about that. It is, give me 1 second, everyone. Let me just reach out to her just so she realized that she dropped. She's supposed to lead today's session, so give me 1 second. Okay, everyone, this is what I'll do. I'll start leading. I do have the presentation here. Chanel is leading today's session, so this is largely her presentation, but for one or two slides that I have, which is at the very end. But let me just get it going. She may have some technical difficulties on her part. Let me get it going, and then what I will do is, as soon as she's able to jump in and take over, then I'll loop her back in. Okay, 1 second. Let me share my screen. Oh, she's back. Sorry for the technical difficulties. It happens sometimes. I was given a talk early this week and I completely dropped midway to. Chanel, I see that you're back. If you want to just take over or continue where you left off. You're on mute.
Hi guys, sorry about that. I'm having some connectivity issues. I'm so sorry. Can everyone see and hear me okay?
Yeah, you're good.
Okay. Okay, sounds good. Can you get my slides up for me, please, Prof? I can't see anything.
Sorry, are you seeing it now, Chanel? You good?
No, I'm not seeing anything. If everyone can see everything though, I can still go ahead and get started. I still don't have any connection, so.
Is everyone else seeing the slides? If you are, could you let us know in the chat?
Let me know in the chat if you guys are able to see the slides. Okay, I see a couple thumbs up. Yes, okay,
Yeah, they
sounds good.
are. Okay.
Sounds good. Okay, so I'm assuming while I was away, you had the chance to introduce yourself and that kind of stuff. Were you able to, or
I
still
I
not
I,
yet?
I did not do that yet.
Okay.
I was just about to start doing that, and then you came back on.
Okay, perfect. So I'm gonna let you introduce yourself before I get started with the content and the slides and stuff like that.
Okay, perfect. Okay, everyone. We're gonna do a series of talks, and we have been doing a series of talks. So far, we talked about strategic planning. We talked about different things. Today's session, though, is financial management analysis. And the big thing, by the way, is that this whole thing is to raise capital. So one of the questions we often get is, okay, what does this relate to raising capital? Well, for depending on how you go to borrow, there are different information that's required, right? The different information required, and part of it is it may be your personal information that's required and you need to show. There are other individuals that just speak with a business owner yesterday and they require a business plan because of the type of loan that they required. So we're giving you the framework for each of those pieces, right up until not next week, but a session after that where we talk about raising capital. And then the last week, we're going to talk about what we mean, how to present it and to tell a story. So just so you know, if you're just joining for the first session, you may see the title Raising Capital, or you're wondering, okay, how does this all fit in? So just so you know. So just a bit of background about myself. Kind of just jump here, then I'll go Chanel. I'm a lawyer. I'm not a practicing lawyer, but I'm a lawyer, master's taxation law. I'm also certified financial planner, chartered life underwriter, certified executor advisor, and all of that has to do with financial planning. But I'm also a certified exit planning advisor, which means I help business owners with their financial plan, their personal finances, but I also help them to get their business to exit at different stages of their business, be it from the employee to the employer, so employee to the manager, from the manager to the CEO, from the CEO to the board to investor, investor to exit, right? So I do all of that. I'm also been in publications, have a book called The Art of Retirement. And I've been on television and in a bunch of publications. So that's a bit of background about me. I'll just have Chanel introduce herself, and then she will lead the rest of the session. And I have just one or two things to add at the very end. Is Chanel off? Is she back on?
I'm here.
Okay, perfect.
Thank you so much for that intro. As I already stated, guys, I'm the founder and executive director of TSK Wealth Planners. I explained to you what that is. Besides all of that, I have a background in finance. So I have my associate's degree in financial management. I have a couple Bloomberg market certificates in both equity investments and fixed income. And then I will be done at the end of this year, my honors Bachelor of Commerce, also in finance at Guelph Humber or Humber College. So with all of that being said, we are here today to go over financial management. We wonder a lot, what does that have to do with raising capital, just like Professor shared with us? But of course, the management of finances is essentially critical to raising capital. We know that when you're going to apply for loans, grants, and I know when it comes to loans, it's sometimes maybe they will, maybe they won't ask you for a business plan. But when it comes to grants, it's 100%. It's going to be at the very least a business plan, and then it's going to have to be tailored to those grants or those funding applications. And then in addition to that, you'll have to have financial statements that you can provide, whether it's a year's worth or 2 years worth, whatever the funder is requesting. So today we're getting started. And I'm going to start with this. The financial management of a business, as we know, is essential to a company's financial health and to their performance. So we know, what can we get from examining a company's financial health? Right from here, we know that we can get an idea of where they are, right? When you do a health checkup, when you go in for a physical, you're giving yourself an idea of where you are right now. What are you doing well? What are you not doing so well? It's essentially an analysis. This has to be step one for us because we need to know where we sit in order to know what we could do to raise our company money or to gain some financial advantage. Let's see the next slide. Awesome, perfect. So today we're going to focus on 3 main areas. Okay, so we're going to look at analyzing financial statements, which I discussed the importance of a few minutes ago. And then we're going to look at financial ratios, but just KPIs. So key performance indicators. These are just some key ratios that all business owners or entrepreneurs should kind of keep appraised on, so that you have a snapshot as to how well your company is doing at different times. And then third and not least, the profitability analysis. So understanding, is my company making money or not, right? As we know from previous conversations, it's really, really, really important to stop and have those check-ins. We probably want to maybe be more than just once a year, or once every 2 years, or more than just setting it to your business and forgetting it. So far, I'll take a pause. Is everyone familiar with all these kind of areas of finance when it comes to businesses? Looking at financial statements, maybe using KPIs or profitability analysis. Give me a number in the chat if you've ever looked at or are familiar with any of these. Use 1, 2, or 3 so I can get an understanding. Can get warmed up here. Give me a 1, 2, or 3 if there's any of these things in finance for business that we're going to be focusing on today that you might be familiar with. We'll see. 2. Okay, Nadine, thank you for that. Awesome. Okay, good. So I see mostly, you guys can correct me if I'm wrong, it seems like mostly the entrepreneurs in here are familiar with understanding, so KPIs, performance indicators, it's familiar. Okay, so then at least I have an understanding of knowing we got to look into analyzing financial statements and profitability analysis, and how this is beneficial to you guys when it comes to being able to raise capital or raise funding for your business. Let's pop into the next slide. And we can even, yeah, perfect. So financial statements, we know financial statements provide, as we mentioned, key insights into a company's financial position. So we can do so by examining statements like the income statement, the balance sheet, and the cash flow statement. So let me know really quickly as well. Is anyone familiar? Let's use 1, 2, and 3 again. Let me know if you're familiar with any of these statements, because we're going to take a quick look at what one of each of these might look like. Let me know this exact same way in a chat. 1, 2, and 3. Have you seen income statement, balance sheet, or cash flow statement before? Can let me know. I'll give you guys a second. Okay. And says income statement. Okay, awesome. Perfect. Thank you guys. Thank you for the participation. Okay, good. That's good to know. Okay, so balance sheet seems popular as well, right? Balance sheet, income statement. So here's a sample of, no, you could go ahead, Prof, too. Okay. Yeah. So for our income statement, we know the income statement evaluates a company's revenue and their expenses. So essentially, you're getting a chance to look at the profitability of that company over a period of time. I can do income statement for a quarter. So that could be maybe September to December. I can do income statement for the year. So that could be if my year started January to December as well. As you can see with our little example here, we've got income statement, you would have the period underneath, and then you've got revenue, cost of goods sold, so on and so forth. And you can see that revenue starts at the top, and then each of these things chips away at that. So as we've talked about, if you were ever in one of the financial seminars in the past, as we talk about, it's really, really, really important to track your business expenses, right? And make sure that every expense that you accumulate for business, so let's say, for example, if it's going to be an internet bill and you need Wi-Fi, is this Wi-Fi directly generating revenues for your business? So, right, it's expense recognition. We talked about that in the past. Is everyone familiar with that? Expense recognition. And if anyone wants to come off mute today, that would be nice. I remember last season we had lots of talkers. So if anyone wants to come off of mute, and share anything about income statements or experience with that, that would be good. Or you could type in the chat. But for now, I'm going to move on from income statements. So is it straightforward? Income statement period, you usually start with revenue, right? Good. So next, we're going to take a look at the balance sheet. So balance sheet, again, snapshot, right? Every time you take a financial statement, it gives you opportunity to look at the business at a quick point in time, because something could happen tomorrow, something could happen next week that could change the circumstances. So the balance sheet gives us a snapshot of the company's assets and liabilities, and then shareholders' equity, if we're familiar with that. Some of us are SMEs, small medium enterprises, so oftentimes there's not much discrepancy with shareholder equity and that kind of stuff, and that's okay. However, you still want to make sure that you have an idea or an understanding so that you're opening your capacity to be able to be as big as you need to be, right? So typically with the balance sheet, you see you'll have assets on one side, liabilities on the other side, and then you've got a balance of the two, right? Okay, so we can move on. Unless, Prof, do you want to add anything about the balance sheet?
I mean, one thing I would like to say is the income statement represents the past, the balance sheet represents the present. So a lot of times, if you want to see what's going on in the business, I look at the income statement. At least that's where I usually start. I start because it usually tells a story. You know, revenue, cost of goods sold, and all of that. You see what has been happening, because that also tells you, depending on what's happening, it's going to affect what's the present and ultimately the future. So if I look at the income statement and I see that, okay, well, no, we have negative profits, our profits are pretty close, then I know potentially in the future, if we have any challenges, we're going to have huge potential problems. But if you look at an income statement from the past and you've seen that, okay, decent profits, things are going great, what it tells me is that it's going to reflect, hopefully reflect very well on the balance sheet, unless we have previous debts and things like that. But the place where I usually start is income statement. Cash flow is such a huge part of it. I think we mentioned this before. When you go to borrow money, you could, even if you have a decent net worth, sure, I'm not saying that isn't great. It is great to have a decent net worth, but if your business does not have cash flow, for banks, it's a problem. They're more likely to lend somebody who has a lower net worth but has cash flow in the business, because they see that you have movement. And even if your cash flow is not where it should be in terms of net profit and stuff, a lot of time the presumption is, listen, these people, they're getting money in, they're getting people in. There might be some tweaks and stuff that need to get resolved, but we trust that they will fix it over time, because the hardest part of the business is getting clients. So when they see cash flow coming in, that usually looks really well. So I'll hand it back to you, Chanel.
Awesome. Give me a sec. My screen just went small here. Sorry, guys. I don't know how to expand the Zoom app again, so bear with me a second. Oh, maybe here. Would you guys be able to tell me how I could get the screen back to normal? Right now, I'm looking at just a bar at the bottom. And I'm not seeing the screen as normal. Okay, that's okay. I'll go from here.
Are you seeing the slides?
I can see the slides because they're on my own computer, but not from you guys. I only see your
Okay,
face. Yeah,
There should be a
but that's
little
okay.
box and an arrow at the bottom, like a little box with an arrow, and then you click on that to expand it.
No, let's not take too much time on this though, because everyone waited already. That's okay. I'll figure it out myself. We'll go to the next slide. I kept some important notes for you guys here besides just the financial jargon and the looking at the statements, right? So when we're evaluating our financial statements, we want to look beyond the numbers. So while the numbers are crucial, understanding the context. So this kind of just supports what Anthony just said to us, which is having the understanding that, let's say, for example, you could have two companies go to the bank. One company has great net worth, seems like the company's worth $3 million. They're thriving with assets. It's going great. We have another business owner come in. They've only got maybe, let's say, 250K in assets or so, but cash flow's great, right? Every month they're able to kind of pull in maybe 20K in revenues. They're increasing a small bit each month, so on and so forth. The bank is most likely to loan to the bank that has a higher cash flow. Why is that? What does that mean? It's capacity to pay, right? It's the idea that if anything, over time, this company is going to be more likely to pay us back, right? A company having assets or having a high net worth on its own doesn't necessarily mean much to banks or much to lenders, but being able to produce income in each period, monthly, weekly, so on and so forth, just tells banks and lenders, but you could pay me back though. And that's what they want to know. So we want to always keep that in mind. If there's something that we can do as business owners, less asset acquisition, because you can even use debt to leverage. So less asset acquisition, more focus on cash flow, right? So it's that idea of looking beyond the numbers. Then next up, I would say you want to dig into the details. So I saw a few different people share with us today, a few different entrepreneurs share with us today that they're familiar with maybe, let's say, the balance sheet, KPIs, those kind of things. But I know that oftentimes, especially if you haven't studied finance specifically, it's hard to really gain an understanding of what these numbers mean to you. So we want to dive into the details of these numbers, things that that might not be immediately apparent. So it might take an extra step. Let's say, for example, getting a number like profit margin, right? It in itself might not mean much to you, especially if you're entering a new world, a new industry of business where you don't have many colleagues. The profit margin might not mean much to you on its own. Or maybe let's say your profit margin is something like 23, right? And you're thinking in your head, oh, well, on average, like I was hoping, all my friends are saying, a 30% return on income is good. Like, let me see if I could get that up to 30%. We want to dive deeper into that though. So you could do an extra step and skip and see, you know what, let me check what it is for my industry. Let me check how the other companies or businesses are doing in this industry. You might look that up and find out, wow, the average is about 19%. Me at 23, we're doing something right. So these little bits of information and these opportunities to dig deeper, to look at the financial information, offer you insight. So you might be thinking, oh, I thought I wasn't ready for that funding, but I am. Now I can add that to my application. I can show the bank that the telecommunication industry only has a return on income of 19% on average, but we're a new telecom company and we've got 23% in this first year. So just small things like that become important when you're looking into funding. It's about digging into the information you have about your company and knowing how you can manipulate it to almost be in the betterment of your company, or make your company look better, or look like you have opportunities, or be able to open up those opportunities for your business. And of course, finally, here on this point, we want to use multiple ratios for a holistic evaluation. So the understanding of this is to back up the point I just previously told you guys. Can somebody share with me? Let me see if I can share computer sound. No. Can somebody share with me, if possible? Come off mute. I'm not seeing the chat really well, but come off mute and share with me a time when a KPI or a financial ratio, any sort, it doesn't need to make too much sense. If it doesn't matter. Share with me a time when a financial ratio or a KPI was pivotal for you or for your business. I know we have almost 20 people in here today, so I'll give you guys maybe 10 seconds. Somebody can come off mute and share with me a time where a financial ratio or a KPI was helpful for you or for your business. Let's see what we got.
Okay, while people come off mute and get ready to answer or think of something, I will share one situation. So I had this client. The client does really well in terms of revenue, especially for a new business. In a couple of years, it got to 400,000. For the industry, it was pretty solid. But the conversation that the client was, I make all this money, but I feel like I don't know. I feel like I make a lot of money, but I'm not seeing it and I'm not feeling it. And part of the challenge there was that their business was seasonal. So around Christmas time, does really well. But right after Christmas, it drops, and then it picks up again in May, June, and fall, and then it drops a little bit in October, and then it picks up in December. And part of it was the months where they're doing really well. What they also recognize is a lot of revenues coming in, but there's a huge marketing aspect of it, and the charges for the marketing comes in after. So what they're not recognizing is the overall performance versus the time when they're doing well, bringing a whole lot of revenue in. But at times when things are low, they still have certain expenses that's eaten into their margin. So the first thing what we did was we looked at profit, then we broke down the profit by months. And once we broke it down by months, we start to see why it feels like you're making all this money, but really from a profit margin standpoint, they really weren't where they thought they were. And so the net profit was a big thing. And at the end, I'll kind of go over a little scenario just to show you that all revenues aren't created equal. So if anybody else wants to share after that, that's fine. I just thought that would be great to share it from business owners that I've worked with, that just because you have the revenue may not be it. You want to it's good to have revenue. I'm not saying it's not good to have revenue, but you want to take an extra look at the profit.
Yeah. Yeah, I agree with that 100%. If anyone else wants to chime in, feel free to come off of mute, and I'll also just bandwagon on that and share a quick story. I know in TSK Wealth, especially at the beginning of 2023, when we were on our search for different fundings, more specifically government funding, that was one of our hindrances, was being able to understand our KPIs and kind of get the difference between the idea of how well the company is performing separately from the revenues. Because especially that year for us, we had high revenues, but then of course it was still a kickoff year. So we had extremely high expenses, and that gap of profitability was very low. That was our first year being profitable at all financially. So with that being said, having an understanding as to like, okay, this number is high, but what else is affecting this number is also extremely important. Because then let's say in companies where you are seasonal, you have the option to do small things. Like I wouldn't say cut the water off, but hypothetically speaking, right? If your company is more lucrative in the summer, in the winter months, there are probably expenses that you can limit or even pause for the time being or for those seasons, so that you can create a bit more of a gap there between the revenues, which are slowly lowering in your off season, and then your expenses. You can maybe lower them slightly as well in your off season. But excuse me, but that comes from familiarity with your company, right? So you have to start somewhere, and the numbers part is always overwhelming, right? You ask somebody, oh, tell me a bit about your company. They could probably go on with words for a while, but the numbers part is a little bit more difficult. So it's taking that second and being able to know small numbers like your net profit margin, your gross profit margin, knowing your cost of goods sold on a monthly basis, like just those kind of things, right? And before I move on, does anyone want to come off mute and maybe share an experience where any sort of KPI or any sort of financial management they've had to do in their business was impactful? Anyone want to do that? You can chat too in the chat. Okay, so let me just move on for the time being. And if you still want to come off mute, feel free to do so. I know it takes a second. And from here, we're going to move on to understanding financial ratios. But before I do that, I'm going to get everyone to give me a number in the chat. My favorite number is 4. You guys can pick whatever number you want to pick. But everybody who's awake, who's paying attention still, type a number in the chat for me, please, so I can see who we have participating still. Awesome. Thank you, Anam. I appreciate that. Awesome. Thanks, Anne. Thank you. Thank you. Let me see one more. Who else we've got? Awesome. Thank you, Tam. I appreciate that. So I see you guys are still awake with us. Good. So you've got understanding financial ratios and key performance indicators now. If I remember correctly, it was a few months ago, but I think everyone really likes the KPIs. So let's see. Financial ratios and KPIs, as we know, help us assess various aspects of a company's performance. So these type of metrics act as a benchmark. So essentially, if I'm putting out a survey, I can use a few KPIs, maybe members of the community touched. Thank you guys. I see your numbers too. Members of the communities touched, the amount of students that went off to high school. Members of the community touched is a little bit vague. The government doesn't accept that. But the amount of students that went on to maybe post-secondary after trying my program, right? The amount of students that remained in contact. If I'm here with you guys, I could use some KPIs, the amount of entrepreneurs that maybe resorted back to myself or professors' information or slides after this. These are KPIs, key productive indicators, things that could tell us how well are you doing this? Are you doing a good job at this? So when it comes to finance, we've got the same. We've got key productive indicators. So first, before we get into all the numbers, we're going to start with the umbrella. Okay. So I gave you guys the shortest blurb I could think of about each of these different types of ratios so we can have an understanding. And these slides will be available to you guys. So liquidity ratios, we know already. Can somebody, let's see, actually, let's do a little quick test. Can anyone tell me, I'll only give a few seconds, what do liquidity ratios do? Or can you name me a little liquidity ratio? Put in your own words. Let's see. Anyone? I'm going to leave liquidity ratio up there at the top. Profitability ratios evaluate a company's ability to generate profits, which we know we've been talking about. Efficiency ratios assess how effectively a company utilizes its resources. So frequently the question comes up, what's the difference between the profitability and the efficiency ratio, right? So efficiency might be able to tell you, that's a dive deeper. That's saying, okay, so per this resource, we're able to produce this amount, or per this resource, we could provide this many services, which is a little deeper than just the profitability ratios will often just tell us kind of the difference. What's the difference? What's the difference between how much we made on this and how much this costed us, right? The efficiency dives a little bit deeper and says that's where the expense recognition or the revenue recognition comes in. And it can connect a resource or an expense, something the company is using, directly to how it's making the company more profitable or how it's working efficiently. And from there, we can decide, has the company properly used this resource? Did they get the full worth out of it? So on and so forth. So hopefully that makes sense. Let's go back to liquidity for a second. Does anyone know what a liquidity ratio is? Does anybody want to come off of mute? Let's see, I want to give it a chance. Does anyone want to come off mute? Sharika, Alicia, Addis, Nadine, Dwayne, Tam, Anne. I had so many participants. The best of this comes from participation. So let me hear, has anyone even heard of liquidity ratio before? And you can type as well. Have we heard of liquidity ratios? No. Okay, good. Okay, good. This is good. Okay, great. No, everyone said no. This is good. Prof, I'm even going to give you a second too, so they could have the experience that I've had. But I'll put in my words, and then I'm actually going to give Professor Anthony Gordon a chance to share with you guys. So good thing I asked. Thanks for sharing those answers with me, guys. Liquidity is what we just spoke about on the previous slide before I handed off the prof. So it's a company's ability to meet their short-term obligations. What does that mean? Pay your bills, right? Can you pay your bills? Are you making enough money to pay the internet, pay the Wi-Fi? If gas is an expense for your can you cover gas? Is your company liquid? Do you have money on hand? If we give you this funding, can you pay us back month to month? Right? Are there things that you could turn into cash? That's probably the way I would put it. And then I'm going to let Professor elaborate on that one for you guys, because liquidity is very important for businesses.
So essentially what you want to do is look at your monthly expenses. I'll take it down. Let's take it at a personal level and bring it back up at a corporate level. Because I think so we're at different stages in our business and we're probably still trying to figure things out. Think about it at a basic level. You probably have certain expenses that you have monthly. Electricity, you have food, shelter, etc., etc. Those monthly costs are critical to your day-to-day personal just living and feeling comfortable and being okay. Some of it is a bit luxurious, right? So some of it is we're eating our food and we're going to the movies, we're taking trips, we're all of that. Some of it essentially are things that we absolutely need. I always break it down into discretionary and non-discretionary, things we need versus things we want. So the things we need, we always look at what exactly that is. What is that amount? And the things we want, those are the things that are luxury items, right? And at a minimum, what you want to have is a certain amount reserved to be able to pay that off without taking a loan, right? So you look at what your monthly obligations are and how much you have from a cash standpoint in order to pay that off. Think of it at a personal level, because we're at different stages of business. Now think of it at a business level, same thing with a business. What are your monthly obligations in a business? And by the way, this is where a lot of business owners get caught. I'm working with a business owner right now, and they're a husband and wife couple, and they do everything in the business, and they want to hire someone. And the conversations we're having is, how liquid are you to meet those new obligations? You want to hire someone, and you also want to rent a place, right? So the ratio, essentially what it does is it looks at what is your overhead every single month and how much cash you have to pay that amount off without borrowing or going into debt or anything of that nature. And of course, what you'd like to have is the longer you're in business, have a certain amount that you feel comfortable, especially based on your industry and based on the situation that has been in the past. Because again, if you have a business that, for example, a subscription-based business, subscription-based business is you have people who subscribe to your business and you get a monthly amount. I don't know, suppose you're an accountant and you work with business owners and you charge them monthly for bookkeeping services. Then we know every month that money's coming in. And if so, for example, if we're getting $10,000 a month and we know that our expenses are $5,000. From a liquidity standpoint, we're pretty good, especially if we have money saved up. But we also know that we have fixed amount coming in to deal with those costs. So we're going to be in a good position where liquidity is concerned versus a company that doesn't have these monthly cash flow coming in and we have these expenses. So liquidity ratio just really tells us how flexible we are. What's the opportunity that we have in terms of paying off those, it says short-term obligations, I say monthly obligations, a lot of which are fixed. And by the way, I'm not a proponent of fixed costs. It's good to have fixed costs over time. I don't like fixed costs unless it really is fundamental to you earning money. I like flexible costs because if we don't have, to Chanel's point, especially if we're seasonal, why would I pay for example, retainer for marketing if in December, we turn, if in January we turn off marketing, but we're still paying a retainer. What we have is very flexible variable costs. We could lower that retainer with these individuals who do our marketing, and then we could turn it back up, right? So essentially liquidity ratio is looking at your ability to meet your short-term obligations, a lot of which are sometimes fixed or flexible. I like flexible because if you don't need it, you could turn it off. But of course, there's certain things that's instrumental, Wi-Fi. If you do need a physical place, of course, get a physical place and things of that nature.
Yeah, definitely. Well done. So now that we have that, I want you guys, okay, and I see a nice little question. Dwayne, while I read your question, everyone just tap in for me and let me know if you feel like you now understand liquidity or liquidity ratios. The reason this part is so crucial is because oftentimes just the one piece that we're missing, which is why even TSK Wealth, thank you, and for your hand, which is why TSK Wealth is so focused on the financial literacy part, is you can't ask people about money and you don't know about money. And that's the main thing, is when you go into the bank, you go to a private lender, whatever the case may be, sometimes it's simple things like jargon and acumen that make it clear that your business is even capable of taking on maybe some funding or something like that. Because oftentimes what happens is we've got great ideas and we've got good capacity, but we'll expect for an institution to hand us $200,000, but we haven't maybe sat through one of these workshops and understood what liquidity is or what profitability is. So it's really important before we just think, let's go straight to funding and see how my business can get money, to make sure that we can understand what lenders are thinking or what they're looking for. So I hope that makes sense. Dwayne, your question was, can all this be applied to a funding business? Just curious.
Farming.
Yeah, farming, agriculture, 100%. Yeah. If anything, and Prof, I'll let you chip in too. Yeah. If anything, a lot of these principles are foundational upon the barter society, right? The original, where we started from in terms of doing business, which has a lot to do with agriculture and various like farming, natural resources. I say all that to say this: it's direct, right? Cost of what you put in is that, are you at the point where you've got tons of land? Are you using tractors? Are you using machinery? Or are you still small? Are you just an individual? Are you still planting seeds and reaping those seeds on your own? Those kind of questions would make it more tailored. But 100% it's applicable to farming. What would you say, Prof?
Before I do, I definitely, farming as a business, just like any other business, all of these ratios and everything apply just the same. And to Snell's point, I kind of, from an agricultural standpoint, that is where a lot of this stuff comes in place. Except, yeah, there was a barter system. I create yams, you do potatoes, we kind of do exchange. And we hope to produce and have have these resources available. We just use a cash equivalent. No, we use a dollar, or everything's all digital. I see Anum has
Yeah,
hand up.
a hand up. Mhm.
Good morning. Good morning. I just was
Morning.
thinking about some analysis, right?
Yeah.
Because oftentimes, when you do business, depending on who you do business with, you
Yeah.
have the idea of accounts receivable. So here you're getting money, but even when you deal with certain places, they pay you 2 months down the road, 3 months down the road, but the cost is always happening. The upfront cost to you is happening, and now you're waiting for money. So now you have to put that in that money you owe, but money. How do you collect your monies, right? In terms of when the money come in versus what you spend, and when it comes. And I learned now that you have to manage that as well, not just the idea that 10,000, but when is it coming in? Right? Because if we're talking about liquid, you can't spend it until you get it.
Yeah.
Yeah.
So okay, so let me tell you how that shows up in the liquidity ratio. The liquidity ratio is, if I remember this correctly, it's cash or cash equivalent.
Yeah.
Plus marketable securities, that's any type of investments, plus accounts receivable, and you divide that by the liabilities. So think of cash, marketable. So cash is going to be money that you have in the bank, right? Marketable securities. Some people invest in their company, or they have something that they could sell, right? Plus accounts receivables. And the accounts receivables, you cannot really consider that cash until you're obligated to receive it. And then you divide that amount by the current liabilities. And if you're going to be an accurate, if you're going to accurate assessment of it, you would have to have the accounts receivable for the particular time period. So if you're looking at your liquidity ratio and you're looking at, okay, what's my ratio for this month? It's going to be the cash I have, marketable securities I have, and accounts receivables that I am supposed to collect right now or in a week or something now, divided by those current liabilities that I have to pay. So that's right away. That's a good question. Here's one of the things you have to be very careful about with accounts receivables. I have a client, 90% of his business, he does 7 figures. 90%, so just to give you context, 90% of his business comes from one client. And what I'm telling him is, you got to be very, very, very careful about that. And what happened was that client was late in paying. Yeah, Nadine, I'm going to tell you shortly. That client was late in paying. And so what happened? All his liabilities, expenses for the month, he could not meet them. And so no, he has to go to the bank for a loan. And so one of the things that I have to book a call to talk with him, because we're going to look at his business to create diversity in his business. Because from a valuation standpoint, also brings his valuation down, but also puts his business at risk. So his liquidity ratio, though on paper it looks good, because these people are supposed to be paying, but all it's technically accounts receivables. Oh, Chanel got it. Awesome, thanks. It's all accounts receivables that he doesn't have yet. He has cash, but it wasn't enough cash. He doesn't invest in his business, so he didn't have the marketable securities. So we have to be careful. I'm so glad you brought it up. It's really good, especially when we have long-term commitments. When we have accounts receivables, we have to be very conscious and make sure that that money is getting paid. Over time, if you have a majority of your accounts receivable one person or significant amount, I like to say no more than 30% one client. Just be careful of that, because once you go beyond 30%, it just affects your business significantly. So with accounts receivables, yes, it is considered a quick ratio, but I like accounts receivables that you're going to get paid, but be cognizant that if that person doesn't pay, then what happens is you may be in a sticky situation. But yeah, but the ratio typically the presumption is for accounts receivable that you're gonna get paid. That's the numbers perspective. But we know the reality sometimes, we have people who whatever reasons don't pay. Sorry, go ahead. Chanel,
No,
it's almost 11:30.
that was great. And just to just to build on what you were saying too, in terms of size, right? It's a whole new industry, the idea of SMEs. It's like coming back around. We lived in a time where, like we referred to the barter culture of that trade and stuff. Money came in. We hit the peak of the huge organizations dominating the market. That's still happening. But now what we've got is the average person saying, no, I got a place in this, right? Us. So we're what the government now calls SMEs. We've been given a title. And there's a lot of things that might be, it's not individual, it's not consumer, it's not big corporate type of tips, but it's right there in the middle for the SMEs. One of the main things I would say that even works for me too is if you are, and when I say long term, I'm talking like 5 to 10 years of consistent and growing revenues. If you're anywhere still establishing SME, that kind of thing, I personally do not include accounts receivable in my quick ratio. So it's a choice, of course, but I don't, given the fact that there's a possibility these people just won't pay and it's gone, right? A lot of what these other corporations have that we don't have as SMEs is they've got now partnerships with debt collecting agencies. They've got this and that type of infrastructure set up in their business where when these people, whether it's B2B or B2C, when they don't pay and stuff, they got somebody to go knock on the door, call their phone, annoy them, collections, right? That's what we call collections. If you're not at a point where you can hire a third-party collections company, which is majority of us, I would almost say you have to think of those accounts receivable as almost like it's like a gamble, right? It's like an investment. So it's great if it comes, but it's not the best way. You want to do as many real-time transactions as you can, as much revenue recognition as you can in the moment, as much prepay for this invoice as you can. Can you pay for half upfront? Can I get it in 3 pieces until the work's done? These types of small things are helpful to SMEs because we typically don't have the additional legroom to hire collection parties. So you don't want to keep your accounts, and especially, for example, as Professor Anthony shared with us, his friend still has a financial manager, which is him. So he still at least got another one person holding him accountable, saying, hey, I'm kind of watching this. This might not be a good place to be in. So if you don't have those financial structures in place, be very careful about how much value or how much you even allow to be put on accounts receivable. And that's what I would say. And even with trying to get the ratio as current or as relevant as you can with the time period, also too, at the same time, avoid it. Try to avoid it when you're working with schools and that kind of stuff, partnering up. I know what your business is. Try to avoid the accounts receivable. Say, hey, I'm going to need this bit up front, or we do this, or is it possible that you guys can try to incorporate some of that stuff, net 30 days, whatever the case may be, so that encourages people to come forward on the accounts receivable. So hopefully that helped. I know you got a lot more than you bargained for with that question, but I hope that helped.
Okay. That's very important. I think I like the idea of the diversification because to bring in cash, because as I said, you could do B2B or B2C. So you might need to then put some energy in the B2C. So you bring in, you sell on, let's say, internet, people pay, they get it delivered, then you have those money in real time. Okay.
Yeah. Exactly. I think it's, like you said, diversification, exactly that. Yeah. So I'm happy that answer helped you. So now I'm back with some notes for you guys again on this part. So we want to be selecting relevant KPIs, right? Depending on your industry, again, like we talked about earlier, industry, type of business you're conducting, all that kind of stuff. Make sure you do a little bit of research and look into what's important to you, right? For a guy who's selling toy race cars, what's important to him is not going to be the same as what's important to the farmer, for example, right? Maybe for race cars, you're just worried about getting cheapest possible parts and you want to sell it for as cheap as possible because it's a toy and you want parents to buy. But when you look on the agriculture end of things, you want to go best quality possible, because especially in 2024, people are literally willing to pay double and triple what a person would pay for the average meal just to feel like this is natural, locally sourced, organic, right? So there you might be able to have a bit more wiggle room to put into the cost of goods sold, because people might pay that higher price. So these are things that indicate to us that we might need different ratios to measure our performance depending on our industry, right? So we want to select what's relevant. Does that make sense to everybody? And you can always talk to somebody, like you could reach out literally. Let's say this is done and you had Professor Anthony Gordon's email and you said, hey, Prof, I was in your BBPA session. Ask a specific question, right? He's not available just to everybody all the time, but ask a specific question. Say, I'm in this industry. What are some key KPIs I could use? Try it, give it a try, right? That's not, I've been in that situation. I've done that. So you could do it to me. You could do the same thing. Hey, I'm in agriculture. What are some KPIs I should look at? Maybe I'll send you a list, 5 or 10. Wow, great. And then you go and do some work. So these are small things we can do to just introduce ourselves to how we can start with that financial piece. Okay, Dwayne, good. Good. I'm glad. That's the goal, is to have a lot to digest, and make sure if you have any questions, stick around to ask them. We give about 10 or 15 minutes at the end. So hold on to those questions if you're not ready to ask yet, so that we can clear some of that stuff up too. I know it's a lot. Next point we've got here is that benchmarking is key. So again, another topic we discussed, you definitely want to do a recurring theme you guys are going to see is you got to do a little bit of research, right? There's only so much of the umbrella that can cover every single person, but kind of as Prof. Anthony mentioned, like there's so much diversity in here. So we've got to make sure we do our own research too. Benchmarking is understanding, right? Is that industry return on investment even sitting at 30% for you to be aiming at 30%? If that industry average ROI is 11%, I mean, I don't want to tell anybody they're incapable, but you got to think, right? Who am I coming into this industry thinking I'm going to get ROI 40%? And the average of all companies in this industry is at 11, right? So these are just small things we want to know. Benchmarks. Where should I be? How could I get there? All that kind of stuff. And then obviously the monitoring trends over time, right? If you're not a numbers person, you're going to hate to look at the numbers, but I'll tell you guys right now, if you set up a business, set it and forget it does not work. Once every 2 years does not work. Even in the earlier years, if you've got anything that has to do with inventory services, you might get a little leniency. But if in the first couple of years, if your business has anything to do with inventory, you've got to be doing financials every day, right? And on maybe a weekly basis or a bi-weekly basis, you want to be about, because you want to catch those trends as quickly as possible.
Completely agree with that. I mean, especially if you have money going in and out constantly, at a minimum a weekly, but really you should probably have someone, if not you, someone in your business looking at that thing daily to catch trends, especially if you have a marketing component or you have an expense component that constantly is going out and it fluctuates and it varies. I agree with you, Chanel. It's so easy to get lost in that stuff. Think you're making money, you wake up one day and go, oh my God, what have I done? Or
what happened?
Yes.
Yeah.
I'm telling you, it's huge. Have someone at a minimum once a week, but if you can, have somebody look at cash flow daily.
And this is again admission of guilt, you guys know I'm super honest to you guys. Obviously our business takes some money in different revenue streams, consulting services, B2C and B2B partnerships. The moment I started looking at my financials on a daily basis, boom, we signed 2 partnerships at the beginning of summer. Boom, 3 clients we're not even mid, I think we're quarter way through the summer, right? We're up social media engagement. I won't tell you guys all of our KPIs here today, but it is instantaneous, the difference it makes when you start paying attention to some of these KPIs and to your business's actual financials. I was given some advice last year, I think it was, networking with Tafari Bailey, who you guys are familiar with, the founder of Hutsy. And one of the things he told me, like a lot of people pay attention to how well their business is doing socially, which is very easy to get caught up in, especially when you have a new business. Oh, everybody knows about it. It's making a lot of noise, that kind of stuff. I think Tesla wasn't profitable until like, I think it's still not profitable. Twitter, another company, still not profitable. Two companies I named, I know you all have heard of it. They have zero profitability yet. I think Tesla just became profitable last year.
Tesla just became
So,
profitable.
yeah, last year. So these are really good examples of how you don't want to confuse like a social climb with actual success in your business, right? I know you guys get that. So Dwayne asked us, can you find benchmarking through the government of Canada?
This is, I don't know if we're good at Canada. What I usually do is I work with business brokers. I like to look at industries, valuations of industries. I have business brokers I work with. So if I work with a client, I'll go to a business broker and I'll say, hey, this industry, can you tell me what the typical, I always look for, these are things I look for. We're going to talk about exit planning and valuations next week, how to exit different strategies, different parts, different parts of your business, from employee to manager, et cetera, et cetera. But what I always look for the industry, then I look for valuations within the industry. And valuations usually have drivers. Drivers meaning for some it's how much recurring revenue you have. Some it's how much infrastructure you have, how your business model, all these different things. So I look at industries, and one of them also is an industry. They look at profit margins, and so I'm able to tell from that. I'm not saying government of Canada doesn't offer that. Government of Canada probably does. I just partner with business brokers because these are people who are selling business day in, day out. When I reach out to them and talk about the industry, I know the information I'm getting is information that's relevant this year at a minimum last year. And so it's more relevant. So that's how I'm able to say, working with a business owner, okay, what's the industry? Get the drivers. In addition to the drivers, I go, what's the profit margins? And then to Chanel's point, you look at an industry, you go, the best in class, suppose the best in class is 20%. And I'm doing 13%. I go, okay, well, something's off whack here. Like, what is out here? And I do what I can, and I look at the industry and see what I can to improve the profit margin. So government of Canada may have it. I am not sure, but I usually get that from business owners and people who value their businesses.
Yeah, I would double down on that too. It's no like, and I mean, I love the government, I love the banks, I love institutions. People know I'm not an anti, I'm all for the system, but that's another topic. But I would also say no to the government for these benchmarks, just because, to further what Prof. Anthony said, which is that it's just not up to the times. The government does surveys typically every 4 years or so. So you'll see that, I don't know, I think it was 2016, then 2020, and then 2024. So the information's a little bit too, what's the term we're looking for there? It's like, it's too technical. So it's too past tense. It's like a lot of this, okay, the last 4 years. So let's say, for example, sometimes I'll look for stats. As I said, I stopped doing government because it's usually census. It's accurate, but it's older, right? Which doesn't really help you when you're trying to make business decisions in the moment. We've only just got into a world where we say, okay, technical analysis is good. Like, we could use some past behavior to predict future behavior. We're kind of seeing that works a bit. But for the most part, you want those numbers to be as relevant as possible. And we don't want to be doing business in 2024 with a survey that was last conducted in 2020 of the manufacturing industry. Because I can tell you right now, AI and tech in the last 4 years has probably cut some of those numbers in half, right? So yeah, we don't want it. Facts, yes, but benchmarking financials, no. I would say keep it in the market. Like Prof said, he interacts with a lot of businesses, so he could get those different brokers and stuff. I also use Yahoo Finance. And then to get news and stuff like that, relevant news, I use Yahoo as well, but I also use Forbes, I use Bloomberg, and I use the New York Times. So Yahoo is a good financial resource. They'll give you those financials. You could find those ROIs, the industry benchmarks. It's very user friendly for the everyday person. And then if you're looking into like news on your industries, and you want to know what some of the bigger change makers in those industries are doing, if you're in farming, you want to know what's good in agriculture, I would definitely say get on a little Bloomberg or get on a little Forbes or New York Times, one of those, and tick off your notifications for agriculture and farming, so that day to day, week to week, you get those because the market changes that quickly, right? Something comes out right now. Little girl found hair in her Kellogg's. Oh boy. Everybody's selling off their, I don't know who owns the Kellogg's, whatever, P&G. Everyone's going to sell off. Price goes down, whatever the case may be. You got a couple smart guys, right, that are going to be fundamental investors that are going to go, give me a break. When this news blows over Kellogg's, like, you can't get over one on Kellogg's. So they go, hey, well, everyone's selling, I'm just going to go and buy. Then everyone forgets about the hair in the Kellogg's box. In a few years, the price goes and rebalances, and now Kellogg's is up in worth, right? These are day-to-day things that affect the market and affect industries. We won't know them if we don't keep up. So whatever industry you're in, make sure you know what KPIs you're looking for, get on some platforms that can give you that info, and then make sure you're checking in. Check in on your industries weekly if you can, daily if you're able, bi-weekly, whatever, but frequently, right? Okay. So let me hit you guys here. Contextualize ROI. We just went over that, so I won't be redundant. And seek continuous improvement. So profitability analysis is not a one-time exercise, which is also essentially what we just talked about, right? This is not a one-off thing. You want to develop a deeper and deeper understanding of it each day. If there's something small you can do to get started now, to start understanding your company a little bit more, a number you could start watching, start that now. And then continuously connect with Anthony Gordon, connect with me, Chanel Smith, come into these bbpa webinars and continue to seek ways that you can grow in that aspect, right? Before I give everybody, I'm going to give AG a chance to go. I'm going to give people a chance to ask questions, but since these slides are going to be shared with you guys, I just shared, I'm not going to go through everything, a bit of information. As a matter of fact, my interns actually worked really hard to help with these slides, so I'm just shouting them out right now. But a bit of critical information that you would need as like business owners or starter business owners, and you could have this. There's some after tax, like that kind of stuff. Again, not going to go through it, but some just general definitions, breakdowns, whatever the case may be. Okay, so you've got that there. The slides will be shared. And then just an example of an income statement, right? Simple. These are like basic level, user-friendly, ready to go for you guys if you want to give them a try or if you need them. Okay.
Let me just, I'll just
AG,
jump.
go ahead. Yeah.
So I just want to, because I know we're talking about numbers, ratios. People are, okay, that's a whole lot. I want to give you this. If you're not sure where to start, I use this example. Yeah, we do share the slides. Oh, I'm not sure how it gets shared, but it does get shared. I think it gets emailed. Oh, Alicia says she hasn't received any yet. Chanel, I don't know if you want to look into that.
I'm going to connect with the bbpa and see how you guys can get, because it would probably even also be helpful to have the slides like even in real time and stuff like that. So we're going to connect and work out a way to make this like the most accessible to you guys. Yeah. But
that's great, because they have all your emails for everyone who registered. We'll reach out to them and make sure it's in. Okay, so if you're not sure where you are, this is where I would start. This is, by the way, an industry, as an example, an industry that aims for 10 to 15% pre-tax. So this is where you'd start. You go, okay, Anthony, I just see a whole lot of numbers. Just give me something simple to follow. All right. First, you want to do, look at your industry. You probably want to start with what's a good aim for pre-tax profits. Once you find that out, you go, okay, great. Now I know what I need to find out. So the first thing you do is you want to, of course, look for profitability. I think we're all on the same page with that. And I know we all look to Silicon Valley and all these companies that, you know, earn no revenue for how many years, like the Twitters of this world. That's not us day-to-day small business owner. That's not us. First thing you want to do is the cost of goods sold. That's a cost that goes directly towards producing your product or services. Everything that requires. If it's a physical product, you have materials, you have subcontractors, whatever. If it's a service, you may have platforms you use, you may need internet, whatever it is, you need to get flat on. For me to produce this service I charge $5,000 for, what are all my equivalent costs with that? For me to sell this journal, what's all my costs associated with that? For me to sell potatoes, my 100 pockets potatoes, how much does that cost? After you have your cost of goods sold, then you look at your actual revenue. That is, this is the cost that is going, and I'm going to give you an example of this. I know what my cost of goods sold is. This is my revenue. This is how much I actually take in. How much you take in, your revenue minus your cost of goods sold, that leaves you with your gross profit, right? And then if you want to have pre-tax profit, we look at your revenue, we minus your cost of goods sold, then we have direct labor and all expenses. Again, for this industry, it was 10 to 15%. Here's what this looks like. And this goes to show you, by the way, this is a company making $20 million. And you go, two companies, company A, 20 million. And you could, $20 million. I never envisioned, okay, well, make it 2 million, make it 200 million, reduce the zeros. The numbers are the numbers are the numbers. What's more important is we're going to start at the top, look at the bottom. You notice at the top, both companies, hey, company A, my company did $20 million. Woo, that's a big company. Oh my God, that's amazing. Company B, we do $20 million. Oh, great, that's amazing, right? Two big companies, $20 million. You hear later down the line that company A files for bankruptcy, or they're going out of business, or they sold it because it's not profitable. And you go, what? That company makes $20 million. That's crazy. Well, what's the first thing on the revenue? Cost of goods sold. Folks, this is immediately hits the bottom line. Because the cost of goods sold for company A is 14 million, while the cost of goods sold for customer B is 600 million, right? And so when you're starting off with a higher profit, it already puts you at an advantage. By the way, look, and then we see after the cost B, company B is more efficient. They have direct labor is 400,000, direct labor for cost A is 3 million. And then so we have, and then we have additional operating expenses, facilities. We have, and by the direct labor is, we're paying to get stuff done. You have facilities, you have marketing, you have salaries, you have payroll taxes. By the way, company B is just more nimble, right? They might be creating value in the market to the same amount, but company B is just more nimble. And it's just more, it's just lower overhead. The net operating income for company A, as you could see, is 670. No, you might say, I don't have a $20 million company. Maybe I have a $200,000 company. Well, okay, in this case, it would be 67,000. Again, no big deal in terms of numbers. But then we have $500,000. Then we have some depreciation, which is more of a tax thing. And then we have pre-tax profit. The other end, as a percentage of gross profit, company A is negative 14%. Company B is 34%. This could be a company in the same industry. But only thing is they allocate their resources differently, and it makes all the difference. So company A may have good months. You go, oh my God, we're killing it. We made $200,000 this month. Yeah, you made $200,000 this month, but at what cost? Right? So this is the importance of paying attention to your numbers. And this is why, by the way, somebody telling you that they have a company that makes, I think Chanel said it in the beginning, a company that somebody says, oh, I'm killing it. I'm doing so much. This is how much I make. It doesn't matter how much you make. Well, it does matter how much you make. It's helpful if you make a lot, but it's also good if you have great profit margins to go along with what you make, right? Which is what, the client I was talking about who's 400. No, what they want to do for 400 is she wants to go higher. What they wanted to do was the facilities. They were going to increase facilities, and they were going to have additional salaries, right? Right now, they're doing okay from a margin standpoint, but they're not hiring anyone. What they need to do is, for one, I would not make it fixed cost. I'll make it a variable cost. And they should do something like this before they hire, meaning, okay, let's put in the numbers. Let's see how much, okay, we're going to right now. So for example, if company B wanted to expand, Well, company B would be like, okay, I'm going to expand to get additional facilities. Well, I'm going to get a new facility that's going to be an extra $100,000. Oh, and I'm going to hire somebody else. That's going to be an extra $200,000. No, you have to recognize, well, that provide the ROI that is needed to substantiate hiring these individuals to get this new place. You have to be completely flat on that. And what I always say to small business owners is, do this proof of concept. Instead of committing to renting this place out for the whole year or 2 year, or God heaven forbid, 5 years. By the way, I made a mistake with the 5 years. I had to eat that. And when COVID came and none of my clients would come into the office, none of my agents would come into the office, and I have this 5,000 square feet place, it drove me crazy every month paying this bill. And eventually I paid to get out of the lease. I got somewhere much, much smaller that I still have today. That's flexible. If I need to be someone, I go there. But it's a place where if I need it, I have it. But if I don't have to go, so the overhead cost is not substantial. So that's what you want to do. So for clients, you may be here and you want to plan to go somewhere else. We'll put all of this in place. And not only just run the numbers, run a test, do a month. Okay, I'll do a month to month. Negotiate. By the way, there's a whole bunch of vacancies now in Toronto, and I'm pretty sure in the GTA. So people are more likely to do a month to month now, more than ever before, and say, okay, I want to rent this place out for a month or so. And what I want to do is, if it works, I'll take this on a long term. Rent the place out, hire the person if the numbers make sense, then track your numbers. And again, track it daily. See how much is being produced, see what your expenses are incrementally. And once you work that out, after 2-3 months, you go, okay, well, whoa, this is a lot more bargain for. And pull the plug on the whole thing if it doesn't work. Say, sorry, I hired you, but I hired you on a consultant basis. This thing didn't work out. Listen, you are a great person. I'll probably reach out to you in the future. I just need to get my business model to make sure that the numbers work. If you hire a locked-in person to hire, that's a cost you can't substantiate. If you then do a rent a place, that's something you can't substantiate. So you have to be super careful about that. So I just want to drop this in because you have people, don't be fooled by people too. People go, oh, I make $10 million, I make $20 million. You don't know what your books are like. You know what I mean? So just be careful about that. Stick to the business principles. Even what I say, don't worry about, I could say whatever. Look at the numbers, look at the formulas, look at the ratios, apply them to your business. Because one thing we know is if you stick to the business principles, the principles won't lie. 20,000 minus 14,000 is going to be 6,000 every day of the week. And versus 20,000 minus 600,000, it's $1.4 million. From a principal standpoint, company A, company B, which company you want? You want company B. All right, cool. So now what you do is you model your business off these business principles. And the principles are you want to make a profit. Because for us small business owners, there is no unicorn investor or whatever they call angel investor coming to give us $20 million when things go down, which is what all of these big Silicon Valley, by the way, and this is how I wrap it up. Be very, 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 very careful of all the stuff that you consume in the media because you don't know what's going on. And a lot of times they are building business purely on debt and they're positioning valuations. And a lot of times those valuations are out of whack, meaning they give a valuation that is pulling out of ear. Stay grounded in this is the industry. This is my net profit. Next week, we're going to talk about valuations of businesses, net profit time multiples. And to Chanel's point, where you look at an industry, multiples are based on how best of class you are in your industry. So stay grounded on things like that. My net profit is something I can manage. My multiple is something I can manage. I now have a sense of what my valuation is. And I also know what my net profit is. So keep this in front of you and don't get lost because it's so easy for you to be making all this revenue and not necessarily see the profit.
Mm-hmm. I agree. Actually, now I'm recognizing this exercise right now that I'm looking at company A and company B. And I would just reinforce, double down for you guys. This is probably an important slide. What slide is this? Slide 28, to keep with you. And if you're getting into the financials, to kind of keep just in the top left-hand corner of your desk, to be honest with you. This is a really, 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 really good example of like where you want to be and where you don't want to be. If like, regardless of industry, using these numbers to look at like healthy company, not healthy company, the only thing these two companies have in common is the fact they make the same amount of revenue. But what is the most common metric that is used when people are out there kind of talking? And as we said, don't be fooled. There are people making 6 figures off one product, and there are people with several I told you guys, Tesla just became profitable last year. That was a rich man playing around with all his ideas. He didn't care if we bought it, if we didn't buy it. He knew, right? Consumers, curiosity, we don't have the money. He'll make back the money, and that's it. And we bought right in. But as business owners, as we're gaining our market share, we want to kind of be aware of some of this stuff and aware of some of our employees. And kind of like Professor Anthony said, we want to protect ourselves first, protect our businesses first. A main point I wanted to share with you guys was just a point of contention that I had recently, and like, you know, just a little social debate. And it's that idea, especially I'm just drawing everything back to being of entrepreneurs from marginalized communities. This is our target, BBPA's target. And it's that idea of, we often look at like big corporations, the government, stuff like that. I'm like, oh my gosh, like they're so wicked. All they care about is money and so on and so forth. That's what business is about. So if you're confused, myself, Professor Anthony Gordon, can straighten that out for you. Business is about money. There are CEOs of certain companies, their fiscal obligation is to make decisions that are most profitable for the company. Some people are bound by that legally, some people are, but I say all of that to say this: as business owners from marginalized communities, if we want market share, and if we want to be out there and have some space in the economy, we have to worry about profit.
Mm-hmm.
We have to make decisions that are profitable for our businesses. Oh, this is nice, you know, I could do this and it would be so nice for my business to also. No. Does hiring this person make us more money? Does starting to use this material instead of that material make us more money? We have to start making those kind of decisions as business owners, especially coming from these communities, to be able to gain market share, because then you can't compete against company B, because company B is saying, listen, I'm keeping that margin. I don't care. I make 20 mil. I'm not trying to make more than 20 mil. What I'm going to do is lower the cost of everything, lower my labor, lower this, that, and the next. Meanwhile, company A is like, listen, I'll just keep probably pushing for more profits. We might see company A at 40 mil next year, but then they'll also be at 50 mil in expenses, right? So you got to decide what type of business owner you're going to choose to take position of in the economy, and then kind of get on that. That would be my little final piece. Are there any questions or anything from you guys? I know you probably want a second. I know today was like a lot to take in. Everyone's like, wow, this is a lot. Not in a bad way, but everyone's like, okay, this is a lot. This is good. So if there are any questions, comments, concerns, I would say this is the chance. If you want to come off mute, you can come off mute. And I don't know if you have any questions. Usually you've got some stuff to say, or we can type in the chat as well. Dwayne, go ahead with your question, love.
Yeah, I had a question about, again, where we're talking about like benchmarking, and ask, could you also use like Google Alerts too as well, or no? Like, would that help too, or is that kind of something else?
Yeah,
Like,
Google might give you too broad of like let's say if you went into Google and you wanted like alerts for like agriculture, it might give you
yeah,
everything.
okay,
But if you use like Yahoo Finance, for example, I just suggest them not because they're really user friendly. You can set your alerts on, and then it will do for specific companies or specific industries. So depending on how broad you want it to be, I'm sure Google's still fine. But if you want to be a bit more specific, like I use Yahoo to get those specific notifications.
okay.
Does that make sense? Does that answer your question?
Yeah, no, I've used Yahoo Financial in the past. It's been a while, so I gotta
Okay.
remember to use it again. But yeah,
Okay,
thanks.
yeah. No problem. No worries. Thank you for the question. Are there any more questions? I know the benchmarking was an interesting topic for you guys. Seeing the two different companies as well. I know definitely that one got to some being able to see the comparison of the two different companies, the revenue being exactly the same, but seeing how all their KPIs could be so different based on other metrics. So if there are any more questions about that kind of stuff, interpreting the statements, what are you guys thinking? Come off mute or type in the chat and let me know how everyone feels about the information that they took in today. Is it
Yeah,
understood?
what's the biggest takeaway from today's session?
Hi, my name is Celeste. Can I ask a question, please?
Sure.
Hi, of course.
Hi. I think the biggest takeaway for me, and it's something that was already in my head, but that last bit of information really hit me hard about the financial management, because I think a lot, like, I was focusing on exactly what you were saying, was like, how much money can I make? How many events can I go to sell our products? And then when I had to step back because of medical reasons, I started looking at my business a little bit different way. I'm like, wait a minute. If I'm making all this money when I go to an event and then I look at my bank account, I'm going, where's the money? Where's it going to?
Where is it?
And I'm starting to realize that my business plan was so important to me, but then the financial management piece, it's like killing me. Like I'm losing sleep. I'm looking at this and I'm going, my background is in accounting, but it's like, oh my God, I'm so lost. So the question I have, like, for a small business, because the financial piece, and I'm in a program right now, I'm going to be honest, listening to some of the other white well, they call themselves small, but to me they're larger than I am. Listening to them talking about how they're doing this and they're making money, and I'm sitting there going, why am I even here? I can't even compete.
Yeah.
So what kind of advice, or what do you suggest for small businesses to go for help? Like, do I sit down with a financial person? I'm looking for a really good bookkeeper, someone to help me with, but it's like, would that person give me what I need? Like, what do you suggest that we do to slowly manage without being overwhelmed? As of like, going to good marketing help is great, and I spend a lot of money on that, and now I'm realizing that that's really not where I want my money. I want to make profit, like you said. So what would you suggest would be a starting ground, sort of a basic boot camp to get started when you're running a small business?
Right. So, Celeste, quick question. What's your what industry are you in?
Sorry, food and beverage.
Food and beverage.
So private chef, and we do gourmet hot sauces and jerk sauces.
Okay, cool. Do you know what it costs? Do you know your COGS, the cost of goods sold for each item? So how much for you to sell a product, do you know the actual cost from broken down per item in terms of, if I sell this based on advertisement and everything broken down to one item, there is the label, there's the bottle, there is the person who works on it, there is the marketing piece, there is you getting paid. Do you know what your cost to sell per bottle is?
Yes, and the reason why I'm starting to know that, because someone gave me an amazing sheet that they use in their business to actually track that cost. So I just started using it and I'm putting in my numbers now, and I'm feeling blessed because now I'll be able to speak to that when I'm talking about my business, not just about the great stuff, but also about my numbers. So I just got the spreadsheet and I'm working through it now with my numbers.
Okay, so now that you know the COGS, and you know how much you sell it for, you should know your profit per unit.
Yes, and I'm starting, because then for me going into the stores, that's the challenge, because obviously a lot of them are taking a big piece out of our profit. And now I realize from my sheet is for me to add in an additional 50% bracket. So then that way, whatever I make, and I add in my 50%. So when they take their cost off of that, I'm still making money and I'm still in sort of like a safe space. So
Especially
that's the part I'm
B2B.
working on.
Yeah, especially B2B. Any industry you're in, I would say, not to cut you off there, Prof. Even when we're in services, for example, it's automatic. So anyone who acts like they don't understand that, you could just refrain from doing business with them. B2B is always more expensive than B2C. I don't care if it's the same product, I'm giving you the same lesson. If you are a business, you are being charged more for this than an individual consumer, point blank.
So-
So yeah, that's a good call.
100.
Yeah.
So, and so let's listen. First of all, the fact that you know per unit profit, huge start.
Yeah.
Because I know you know unit per profit, and if everything is stable in terms of well, first of all, it sounds like you recognize that your profit margin wasn't where it needs to be. So
Yep.
now you're putting in what needs to happen from a profit margin standpoint. And then if all the costs is fixed, it's just a matter of being in front of more people in order to
Yes.
get more closes, to get
Okay.
more. So, okay, so there are 4 ways to grow a business, right? One, you just want to either get in front of more people, right? The second one is to get in front, is to close more. So first thing is, okay, now that I know my fixed costs, I know my margins, and my margins are where it needs to be. How can I get in front of more people, keeping the cost fixed? So you're going to work on getting in front of more people at cheapest way as possible. Second, your closing ratio. If you're presenting or if you're showing, I don't know how you do it, or you do a taste test or whatever it is, see if you could improve that, because sometimes just doing an extra 2%, 3% in closing ratio could make all the world of difference from a component standpoint, especially when you start to scale.
Okay.
The second thing, the third way to grow your business is ascension model. You have a jerk sauce, you have a cost. I always like, for psychology reasons, to have a higher, more expensive thing you sell. So I don't know. So if you
I did that. Yep.
Yep. So you position that, because what it does, it make your cheaper thing great. And for the people who go with the extra things, you get that extra margin. Then the last thing you want to do is you want to have a subscription model. You want to get commitment from people that every single month that amount of thing gets sold to keep it. So what you do is tweak you turn each of those 4 things or levers you turn. 1, how do I focus and get more people? 2, when I get in front of more people, how do I close them? 3, I need to have a higher ticket thing. The way the profit margin is so high, I may not sell it every month, but at minimum, it makes my cheaper, my lower, I shouldn't say cheaper, my lower cost look more favorable from a price standpoint. But when people buy the bigger thing, oh my God, it's a huge bump. It's a huge bump in margin. And then lastly, what you look at is a subscription model where you offer people like the jerk sauces and stuff like that. You may offer some type of subscription model where that will know you wake up in the morning, you go, okay, well, I know I gotta do all these other things, but at least I know I have 20 sales, 50 sales, 60 sales. So if you work on tweaking those, now that you know your unit per your amount per unit and your margins, no, you just work on tweaking those. That is how you're able to usually scale it out. And if you have additional costs, usually once you hit like $1 million, things just go like additional things come out, new facility, new this. But if you have the right margin locked in place, like last week I talked about a rocket. If one bolt is off, yeah, when you just take off may not be anything. But once you start to hit the stratosphere, everything just starts to rattle and explode. So yeah, that's how I would say do it. I mean, you did a lot of legwork already. You know, your unit, increase the margin. The other 4 things you work on is 1, get in front of more people, close more people. If you have a high ticket thing, make sure that's positioned. You could sell some of those, so it gives you a good little bump in your margin. Lastly, subscription model. Get certain contracts in place that you know you have pre-orders that you could wake up and feel like, I gotta close more sales today.
Yeah. And I'm glad that you mentioned that, because I'm working on all of those, making our gourmet jerk sauce with some high-end ingredients in it, so we can really hit a higher margin and sort of doing some other things. So, but the subscription part I didn't have, so I'm going to implement that, and then I'll circle back and let you know how I'm doing.
For sure. And the last thing is, you got to be accountable, meaning all of these things. Now, remember we did strategic planning. Remember we did a strategic plan where we go, the 3 things you want is whatever action needs to be placed, who's going to be responsible for it, and we review to make sure that all these things are implemented. Because you can, so make sure that even though we have all of that, the accountability piece ties in.
I will. Thank you so much.
You're most welcome.
Awesome. I'm on mute. Okay, great. I think that's where, like you were asking, it's not and especially with the shift of things today, I really tell, and here I'm going to be blunt, I really tell Black people, the financial planners, the financial managers that you're seeing with all these little couple letters beside their name and stuff, be very, very careful, right? That's an industry in itself. It's like real estate. But when you get to like, you know, and Prof AG, like as a mentor to me, what I really respect is it's our people and our cause and our character first, because we kind of understand it already, but it's really getting other people to understand that the community now has to kind of like prioritize itself. So you definitely want some sort of coach, like those kind of things to have that. That's where the accountability piece comes in, because now it's almost ridiculous to think I have two right now. So it would almost be ridiculous to think that while I'm doing all of this, I could also supervise myself and stay fully accountable, right? In the best way. So that's where the external help does come in. It's for mainly, it's not to do the work for you, but it's the accountability piece. But I know we're pressed for time too. It sucks that we just have such little chunk. Dwayne, I want to hear your question. And as well, Celeste, I would say make sure like you connect afterwards. You know, your business model is extremely lucrative. I know like definitely Prof has more to say to you that he can't slide in right now.
Yeah.
And
Celeste,
even, yeah, like even, yeah.
You can reach out. My info is right there.
Okay, I
reach
will.
out.
I
I'm
will.
gonna-
I
let me just
definitely
put the
will.
slide up. Yeah,
It's just the fact I'm
reach
working on
out.
it. So, oh, perfect. Thank you.
Yeah, no, yeah, for sure. Reach out to and even me myself, I could think of some things that I could suggest. I know a couple people that do private chef business and stuff. It's really lucrative right now, especially this year. It's been booming. So for sure,
Okay,
reach
perfect.
out.
Thank you.
Dwayne, I saw your hand go up. No worries, Celeste. Thank you for your question. I saw your hand go up. Let me hear your question quickly. If it's something we have to connect about after, then we can. If it's something we can answer really quick in like 2 minutes, we're already a few minutes over, then we will. So let me hear your question, Dwayne. Go ahead.
Well, I enjoyed the topic. My thing's kind of like, I know I could probably figure out the marketing. Like I have a graphic design background and stuff, whatnot.
Okay.
And then the financial stuff, I mean, I think I'm pretty good with money, but I know for me, it's like I'd rather delegate that stuff because I rather stay focused. But like I only get so much money from like I'm not working, and this is something I'm trying to. I just come to that I might decide to do this. So it's kind of like how can I actually, like I guess realistically it makes sense to do it on my own, but at the same time I don't want to. So it's kind of like I'm trying to think like what should I do, and if I
What can you
delegate
do?
it, like how would that work financially for me?
I'll take this one, Chanel. Every time I work with business owners who are doing their finances themselves, I go, unless you really, really love this thing or you're in the business of bookkeeping, I say delegate it to a bookkeeper.
Yeah.
And also have an accountant. Delegate it to a bookkeeper. And what I would say is look at, if you have most people use QuickBooks. I recommend QuickBooks. You look at QuickBooks, understand what these numbers mean. If you want to take it a step further, you could jump on a call with your bookkeeper. If you take it even another step further, and your accountant, part of your arrangement with your accountant is they have them meet with you once a month to go over the numbers, right? So for one, you gotta, I would say delegate it to the bookkeeper. Get QuickBooks, it's cheap as anything. You could log in 10 times a day. Not that I recommend you do that because you have other things to do. But you could just log in and see your own numbers, have the bookkeeper do the work. Your ROI is likely better used in helping people, selling, helping your own team if you have a team, or selling your products or marketing and everything else, versus you pay $100 or $200 or whatever the cost is, depending on your business, or $300, whatever it is, to a bookkeeper who does that for you. And all you do is just open up and you see all the numbers there. If you need clarifications, you reach out to the bookkeeper. But you'll see the profit, you'll see the cost, you'll see this, you'll see categorization, you'll see why this, marketing, my God, I spent so much on marketing, didn't make that amount of money, the marketing is too high. Then it allows you to make tweaks. Maybe you need to get better ROI. Maybe you're a latency in the marketing, but you could at least have that conversation. When I say latency, it means that you pay for the marketing now, but you don't close the client until a month or two after. But what you're able to see is you're clear about where you're going and where things are. So I would say my recommendation, I say delegate bookkeeping as soon as you could afford it.
Okay.
And usually for corporate stuff, people are having an accountant. This is what I like to say to accountant, my clients tell them accountant, say, hey, accountant, I know you file my taxes, and I know between February and April or thereabout, you're super busy. But other than those times, can I reach out to you either on a monthly or quarterly basis just for you to kind of tell me what these numbers are and have a discussion about trajectory? Other than that, if you have like a coach or if you have like a financial planner like myself who work with businesses or whoever, it's just to Chanel's point. You just, even though you know the numbers are the numbers are the numbers, you also want to bounce these, have conversations with other individuals because there's a mastermind effect, and you start to get a sense of, oh man, I'm heading in the wrong direction, or yeah, it's don't know because you just started this marketing thing, and you know, you just have conversations beyond those that's just in your head, right? So, but yeah, if you ask me, I say delegate. That's just as soon as it makes financial sense, I say delegate.
Definitely. All right, so we have
Yeah,
taken you.
we're
Thank you guys
over.
for even staying beyond the end. No, but we still got a full house. So thank you guys so much for staying. I know today it's hard to put the finances into 1 week, but still for the rest of the series, we are talking about capital in general. But I urge you guys, use our handles, reach out as well, because the networking piece is like, as business owners, if you could form a bond or connection that extends beyond this, and afterwards you'll still have those like myself, Professor Anthony Gordon, as like supports, right? And as part of your network as well. So make sure you connect outside of this chat room. And then keep doing what you guys are doing. On my part, I would say you guys, the bbpa, can get the announcements up for us. And Prof, if you have anything else you want to share.
No, next week we're gonna talk about exit planning, and it doesn't mean selling your business. It means moving through different stages of your business, but at least you're positioned to be able to sell your business and have and have valuation in your business. Only 80% of businesses that go for sale get sold, and it's not because they don't make money. Because most people are selling a business that does make money, just doesn't get bought because it's not positioned well. And a positioned business, even if you're not selling it, is the best business you want to have because it's exit ready. It's almost like a house. I don't know if you've ever sold a house. When I sold my last house, when you stage it, you go, oh my God, why am I selling this house? You know, and you're kind of lost. You're not lost. You're like, you're kind of confused. Like, why am I selling this again? Because you just staged it. Well, consider having a business that's staged. That's kind of what exit planning is. At all stages, you're like, oh my God, this is great. So next week, we're going to talk about exit planning. And then a week after, we're going to talk about the actual access to capital and presenting this information to the bank.
Yep.
That's it.
Yeah.